All right, welcome back and thank you very much for staying with us. As Peter said, we've been tracking the market trends and other economic data that confirm what analysts have been saying, that COVID-19 poses clear and present danger to the South African economy, and other experts say that the South African economy was in crisis already because of debt, government incompetence and corruption. So COVID-19 is just adding insult to injury. So the risk of widespread contamination in the country remains alarming as the country is on high alert. So to analyze this, we joined on the line by senior economist Mike Schussler at economist.co.za. Good afternoon to you, Mike. Firstly, one can look at the leaderboard and high-frequency data as it has been streaming in throughout the day, that things have not been looking good. On your side, what have you been seeing?
Well, I think what we're seeing is a much weaker economy. If you look at the pictures of the highways today, there was far fewer cars. We're waiting for a little bit of data from what the banking system can tell us in the next few weeks. And we're going to be looking at various other things like passenger numbers on airports and the like. And I think we'll see all of them are going to be down. It's definitely going to impact the tourism industry, the hotels, the restaurants, Uber drivers, for example. And obviously, a lot of firms are asking people to work from home, and that means that there'll be less petrol sales. I think also we're going to see a lot of fear, and people are not going to buy durable products either in this environment. So it's going to impact on things like car sales and the like. The thing that we'll probably still see doing better than normal are probably pharmacies, food retailers, and the like. But yeah, I don't think we have high-frequency data that we get daily in the economic sense. Obviously, we do have the stock market, but the stock market at the moment is just a gauge of fear. And the gold price is maybe you could say our insurance price. So what we're seeing around the world is that metals that are used in industry, such as copper and aluminium, are under pressure because fewer cars are being made, fewer fridges are being made. And it's not just a South African problem, but it's right through. In South Africa, it's quite clear that, yes, you're right, we came into this with some of our own problems that were very severe, and the virus, or the fear that the virus creates, is certainly going to harm the economy quite a lot.
Now, I mean, like when we look at the severity of the current global situation and limited scope for domestic fiscal stimulus, is there a scope for, or rather the basis points of about 50 cuts in the lending rate?
I think there's scope under these circumstances to cut the lending rate with a full 1% to start off with and see how it goes, because we are likely to have lower inflation because the oil price is down, and that's our biggest import, although the rand is a bit up. I think we're likely to see interest rates come down with a full percent in the next week or two. I think we've got to join the world with that. Fiscal stimulus, maybe not so much. We can change our priorities in our spending, but what we can do is we can use our UIF money in this time period. That's what it's there for. There's about 180 billion. So the workers that do lose their jobs, or the people that are sick because of the virus, just like you would get maternity leave, you would get COVID-19 leave, say, and that would last, say, 2 months or 3 months until you're cured, and you can't give the virus to anybody else. Then your firm doesn't have to pay you the full money, and they can use that money to get a temporary worker in, for example, in your place for, say, those 2 or 3 months that you're not there. So there are other things that we can do, and very, very interestingly, I think that's going to also look at the sort of international cooperation. Whilst our borders close, there are chances of us lending money at a low interest rate from the American Fed or Reserve. They said they'd make it available to countries. There's also chances that we can lend money at a reasonable rate or a lower rate than we would be able to. From the IMF, they're making $50 billion available. So if we get, for emerging markets, so if we get 1 or 2 billion of those, that could have a serious stimulation, because we could spend it, for example, on healthcare. And healthcare, most of the products that we'll buy might be imported, but the services that we buy will be local people that benefit from it. And that might make up for some of the losses the economy has in, for example, restaurants and hotels and the like.
All right. So am I getting the sense that you're saying it's going to be a skewed stimulation? Because elsewhere in the world, when you look at the economic regions like the US as well as in Europe, there has been reports that the drop in interest rate has failed to stimulate the economy as expected. So will dropping the interest rate help? Because if you can't trade, it doesn't matter what the rate is.
Our situation is very different. They already had very, very low rates. We don't have very, very low rates. We have a sort of average rate for an emerging market. So we can drop that to a much lower rate, and that would have a bigger impact with us, I think, first of all. Second of all, we don't have the room for much fiscal stimulus, but we have ability to borrow from official agencies, and we also have the ability to borrow from the American Federal Reserve that's making some money available at 0.5% interest. That is much lower than we could borrow money overseas in the markets at the moment, and that is something that we could see if we can do. That would certainly help bring in some money, and also I think that might change the direction of the currency, especially after the downgrade. We would probably see a little bit of a comeback for the currency. With the oil price where it is now, I think, it looks increasingly likely that inflation is going to average just 4%, or if not a little bit lower. So we could bring down the repo rate from say a 6.5% or so, right down to say a 5.5%, 4.5%. It should allow a lot more stimulus. There are other things that we can do. We can extend the payment period of certain things, say like cars. If people get the illness or they're temporary, the work is temporarily closed, we can extend the pay period for say 3 or 4 months. That would help a great deal for the people. So there's many other aspects that we can do there. On the fiscal stimulus side, we can, if we borrow a bit of money. We'll have to borrow money anyway. So I think we've got to be clever in how we do it. And we should make use of the opportunities that the IMF, it's not a bailout right now. It's an emergency loan of $50 billion for the emerging markets. We may as well try and get our fair share of that. And we can ask the American Federal Reserve Bank, who've said that they will borrow at 25 basis points more than their own rate to foreign countries that need it. And obviously South Africa would need some. So there are other options and venues open to us right now that we should be using.
All right. Mike, just before you go, like I was listening to Minister Ibrahim Patel yesterday talking about monitoring the impact of the COVID-19, looking at imports and exports, securing supplies, and, industrial measures to protect against infections. So dealing with these measures when there's going to be an economic slowdown, given social distancing and the economic, lockdown, how is the country going to deal with the movement of goods internally and also the imports when you look at the ports that are open? Won't there be a problem there?
There's discussions going on right now between the Road Freight Association, I know that for a fact, and various government departments. There will be a way that they will test and look at the goods that road freighters carry, say, between Mozambique and South Africa on the way to Maputo Harbour. In the harbours themselves, all the freight can come through. It's just the passenger side that they're stopping. So the sailors have to stay on their ships. They're not allowed off and go and have a drink in a bar. I think the whole world supply chain is under pressure. But I do think that there's still some stuff coming through, container ships and the like, and I think there will be for some time. I think we need to also prioritize what we need to get if it carries on any longer. If this is just another 2 or 3 weeks, I don't think it's going to be a problem. But obviously there will be some factories that will not be able to manufacture, particularly I think in the car industry, where it's a lot more just-in-time manufacturing. Just-in-time manufacturing only means that they have got less stock.
Mm-hmm. All right. Well, thank you very much for making time to speak to us, economist Mike Schussler at economist.co.za, giving us his insightful analysis on how South Africa can respond to the crisis that we find ourselves in. Well, tomorrow at this time, we'll be talking about the issue of interest rates, and many experts are expecting a reduction of about 50 basis points. So let's see what happens. We will talk then. It's always a pleasure doing business with you. Let's take a break.